While REIT returns dipped slightly in October, recent data from MIT's Center for Real Estate may signal good news for REIT investors. Here to talk about this is NAREIT Vice President of Research and Industry Information, Brad Case. Brad, after 3 straight positive months, REIT returns were down slightly in October. Any cause for concern?
Not really. I mean, there's no bull market in which every month is going to move up. What happened this month, I think, is that REIT investors really paused to take a little bit of a look at what REIT portfolios were worth, and make sure that they weren't getting ahead of themselves, and that's a healthy development. You don't want to go from one bubble into another, and certainly that doesn't seem to be what's happening in the REIT market.
The most recent data from MIT's transaction-based index indicates that the gap between sellers' demands and what buyers are willing to pay for a property is narrowing. How does this impact the market as a whole?
I think it's very good news for the entire commercial real estate market, and certainly for REIT investors in particular. The MIT index has a couple of different pieces. One is the price index, and that price index is down 36.5% from its peak. That's the prices of unlevered properties owned by institutional investors such as pension funds. That's bad news, but it's not as bad as the 39% that the index was down as of the end of the second quarter. The more important information, though, is from the demand and supply sub-indexes. The demand index is down very sharply, about 42%, but again, better news from the 48% that it was showing before. The supply index is down about 32%. There's still a gap between what sellers are willing to accept and what buyers are willing to pay, but that gap is narrowed, and that is going to be very good news for liquidity moving forward. Institutional investors may start to get a sense that maybe they're out of the woods. There are many private side investors that don't own properties that are as high quality as the properties that are reflected by this index, and so there are certainly many private side real estate investors who are certainly not out of the woods yet.
And what does this mean for REITs?
Well, I think it's very good news for REIT investors. REITs have been strengthening their capital structure in order to be ready to acquire assets when those assets become available. So the news out of the transactions-based index is suggesting that those assets are starting to become available, and REITs are in a position to pick them up. More importantly, it gives investors more confidence going forward in evaluating what the REIT portfolios are worth. That's going to make it easier for REITs to continue to raise capital, to tap into those opportunities for growth and investment going forward.
Will this have an impact on the overall reacquisition of the REIT industry?
Yeah, I think so. The recapitalization of the REIT industry has really 3 phases. The first phase was to address immediate debt maturity obligations, and REITs really accomplished that, especially in the spring of 2009. The second phase was just to strengthen their capital structure generally, and REITs have been doing that by tapping all sorts of different parts of the capital market. And then the third phase is the actual acquisition of the properties, and that has really been on hold until the properties become available. This suggests to me that the movement in transaction volume from the transactions-based index suggests to me that we may be starting to move into that third phase.
Thanks, Brad. For REIT.com, I'm Matt Bishar.